Okay, let's unpack this. Welcome to the deep dive. We aim to cut through the noise and get to what really impacts your world. Today, we're diving headfirst into something that might seem a bit distant, Federal Reserve policy, but trust me, it has a direct, pretty significant impact on your financial well-being.
Especially when we talk about your retirement savings.
Yeah.
Our mission for this deep dive is to pull out the most crucial insights from an article by Doug Young. It's titled Political Influence on Fed Threatens Retirement Savings, and it's from the Gold IRA Company's Bulletin. We're really going to explore these rising concerns about political pressure on the Fed and, the potential long-term consequences for economic stability, sure, but mostly for your personal finances.
What's truly fascinating here, and honestly often gets lost, is how the Fed's decisions and the political pressures they face, they aren't just abstract economic theories, not at all. They actually translate directly into the purchasing power of your savings and the stability of your future. It's like this silent, powerful force shaping your whole financial landscape. That's a really crucial point. So let's start with the basics, the foundational principle. Why does Federal Reserve independence matter so much? I mean, the Fed plays this absolutely critical role in managing the U.S. economy, right? Mainly through monetary policy, which is basically how it controls money and credit to influence interest rates, inflation, that kind of stuff. And historically, its independence from political meddling has been, well, the bedrock of economic stability. It lets them make decisions based purely on the economic data, not, election cycles or short-term political goals. But here's where it gets really interesting. This commitment to independence, it has deep historical roots, like way deeper than you might think.
Oh, indeed. It's not a modern idea at all. The Federal Reserve System itself, created back in 1913, had this very unique public-private structure, and it was specifically designed that way to safeguard it from direct political control. This wasn't just like a good idea they had. It was a lesson learned the hard way, looking back at history. The core idea traces all the way back to the 1790s. America's founders, they were watching the English system closely, and they saw the dangers, the inherent dangers of political interference in money policy. So they deliberately insulated it from the executive branch to preserve stability. We even saw earlier tries, like the first and second banks of the United States. They also operated with public and private stakeholders, structured outside direct presidential control. It's almost astonishing how this pattern keeps repeating. Each generation seems to have to relearn this lesson about Fed independence.
That historical context is really insightful. It almost sounds like the founders were, well, predicting the challenges we face today. So bringing that commitment forward, was there a key moment, a pivotal point that really cemented the Fed's independence in the modern era?
Yeah, a hugely significant moment was the 1951 Treasury-Federal Reserve Accord. This agreement explicitly ended the direct federal government control over the Fed's decisions, control that had been put in place during and right after World War II, mostly to help finance the war. It was a critical step because it ensured the Fed had the autonomy it needed to fight inflation, stabilize the economy without being subject to those short-term political pressures. It really cemented their role as an independent economic guardian, free to make the tough calls for long-term stability, even if they weren't popular right then.
Okay, so shifting from those crucial history lessons to, well, today, how does this political pressure on the Fed usually show up now? Politicians, and you can kind of see why, often want to influence Fed policy to stimulate the economy short term, right?
Yep.
Especially when elections are coming up. They want to boost jobs, boost growth.
Exactly. And this pressure, it can be exerted in several ways,
Yeah.
sometimes subtle, sometimes not so subtle. You might have direct appeals to the Fed leadership, basically asking them, sometimes telling them to lean one way on policy. It also often involves appointing board members who are seen as sympathetic, people more likely to align with the administration's political agenda. And then, of course, there's public messaging. Politicians using their platform to openly criticize the Fed or suggest specific policies, trying to sway their direction. It's this constant dance between economic necessity and political timing.
So the big question then, what happens if the Fed does give in? If it succumbs to these pressures against its core mandate and lets politics drive decisions, what are the real-world consequences? Are there historical examples that just scream a warning at us?
Yeah, the historical record is, well, unfortunately, quite clear on this. When the Fed caves to political pressure and keeps interest rates artificially low, rates that don't reflect the real economy, just political wishes, it can definitely lead to runaway inflation and severe economic distortions. We have a really concrete example from the early 1970s. The Nixon administration, facing an election, put huge pressure on the Fed, cut interest rates. And what happened next? Well, that decision contributed significantly to the massive inflation crisis and the stagflation that followed. It choked economic growth, squeezed household budgets for years. Stagflation, for anyone unfamiliar, it's that awful mix: high inflation, slow growth, high unemployment, all at once. If we connect this to the bigger picture, it shows a clear pattern, right? Giving into short-term political demands for easy money for low rates can lead straight to runaway inflation and these big economic problems that end up hurting everyone, especially people on fixed incomes.
That is a stark warning. And it brings us right to how these policy shifts can impact your retirement savings. Because for many of us, especially if you're near or in retirement, financial security really leans heavily on fixed income investment, things like bonds, CDs, annuities, investments that promise a set return, chosen for safety and predictability. So when the Fed's independence is compromised, what does that actually mean for these critical savings you've built up?
Bah. This is where that double-edged sword effect really hits retirees and savers. It creates a real squeeze. See, when the Fed pushes interest rates down, especially to those politically motivated lows, these fixed income investments just yield less, much less. That directly cuts into retirees' potential income, makes it harder to live off the savings. But it's not just about lower returns. Crucially, prolonged low rates can also fuel inflation. We talked about that. And inflation, well, it just eats away at the purchasing power of the very savings you work so hard for. Imagine your nest egg just losing its value, its buying power, year after year. So this raises a really important question for you, the listener. How can you possibly maintain your standard of living when your investment returns are dropping and your living costs are going up because of inflation? It's a squeeze from both sides. Truly.
It certainly sounds like it. And these aren't just, abstract worries. We're seeing economic signs right now that hint at these vulnerabilities. Take precious metals, for example. Rising prices there have often signaled economic uncertainty, worries about inflation. Right now, gold is hovering near record highs. That reflects market anxiety about the dollar's strength, especially with all this political pressure talk around the Fed. And it's not just gold. Silver prices, the gold-silver ratio, they're also tracking shifts tied to inflation expectations, reinforcing that market feeling. That ratio, by the way, just tells you how much silver buys an ounce of gold. It's a fascinating stress gauge for the market. These aren't just random market moves. They're like a barometer of the market's deepest concerns. Yeah, and what's fascinating here is how these different economic signals seem to come together. They paint this picture of underlying worry about stability. When we connect these indicators to the bigger economic picture, we see more complexity. The U.S. national debt, for instance, is now over, $37 trillion? Astonishing. That massive debt adds another huge constraint, almost like a chain, really, on the Fed's ability to act independently. They have to consider the government's huge borrowing costs in every single decision. That can limit their options, right? And beyond that, we have a weakening manufacturing sector, a labor market that looks a bit fragile. These are more underlying vulnerabilities. So if inflation picks up more, or if growth stalls, these factors could really hit retirees' financial outlook hard, make a tough situation even tougher. It feels like these whispers from the market are a warning that political meddling might force us all to pay a kind of stability tax on our savings again.
So pulling all these threads together, what's the fundamental lesson, the enduring message we need to take away from history here?
The lesson is pretty crystal clear, unfortunately. Once political influence starts undermining the Fed's independence, the economy often suffers. You get that painful mix. High inflation, recessions, slow or stunted growth. And time and again, it's ordinary folks, especially retirees, people on fixed incomes, who really bear the brunt of that fallout. So credible, independent monetary policy, its importance just can't be overstated for everyone. It's absolutely essential for the Fed to manage inflation expectations effectively, to stabilize markets, and crucially to safeguard the value of our savings, yours and mine. Without that independence, economic volatility just fundamentally increases, and that threatens long-term financial security for all of us, but especially for those relying on stable conditions to live.
Right, which means the key takeaway from this deep dive seems unequivocal. Political influence over the Federal Reserve poses serious, tangible risks to your retirement savings. It encourages these short-term economic fixes that might look good politically, but can ultimately lead to inflation eating away at your money and lower investment returns for you. So maintaining the Fed's independence really is vital. For stable economic conditions, the kind that protect your purchasing power as a retiree or a saver, it really just highlights that staying informed, understanding this intersection of politics, monetary policy, and these key economic signals, it's essential. Essential for navigating the challenges facing your retirement security today.
Absolutely. And given these historical lessons and current economic signals we've discussed, thinking about the threats to traditional retirement savings, the implications of political influence on the Fed, well, it raises an important question, something for you to really ponder. In this environment of potential economic volatility, where the very foundations of financial stability might be, let's say, tested, how might diversifying your financial strategy become even more critical, maybe absolutely essential for protecting your long-term financial security? It's definitely a thought worth exploring further.